It's very difficult to know how to evaluate portfolios, financial firms, financial advisors. So after 26 years of being on the front line, working, managing money for individuals, I put together what are the 9 most important elements and ways to analyze in an objective, dispassionate way your portfolio. Put aside the great name of the firm, the great image. Put aside who else works with that person. Just look at the raw numbers. And here is the way to do that. Here are the 9 analytical measures. Rate of return, real easy to understand. And in these calculators that I have, you'll be allowed to put in what you currently have and see what the historical rate of return is. A key, make sure you do it over a 7 to 10 year time horizon. Anything shorter than that, any data that you look at that's shorter than that isn't really statistically relevant. And make sure you don't get too focused on the name of the stock. Look at the category the stock is in. Don't look at the manager or the name of the mutual fund. Look at the category of the mutual fund or the ETF. Standard deviation is a measure of volatility, and you want that number to be as low as possible. Variance drag phantom tax, you've never heard of that statistic. It's a new statistic, but a very important one, because it measures how much risk are you taking for the expected rate of return. And what you simply are doing is taking your standard deviation and dividing it into your rate of return. You want that number to be as low as possible. Anything above 1.5 is not an efficient portfolio. You'd like that number to be 0.8 or lower. If it isn't 0.8 or lower, then you're taking too much risk and your portfolio needs to be fixed. Sharpe ratio, William Sharpe, professor from Chicago, now at Stanford, is part of the team that won the award for modern portfolio theory in 1990, measuring how much risk you're taking for your expected return on your portfolio. That's basically what modern portfolio theory is about, and the Sharpe ratio is another way of measuring that. Sortino, another variation of the Sharpe ratio, but it measures downside volatility. Here's something that you've never seen. Wouldn't it be nice to go to a calculator, put in what you currently have, and know what the historical probability of a loss is over the next 12 months? You can do that. It's a very important statistic. You'll be surprised based on what your advisor has given you or based on what your portfolio is. When you go to our snapshot or current portfolio, you'll be shocked at how much risk you're taking for your expected rate of return, but more importantly, what is the probability of any loss over the next 12 months? That's a very important statistic to look at. And then we go one step further. Based on how much money you have in the portfolio, we'll be able to tell you, based on historical data, how much money is at risk, or what is the maximum amount of money at risk. Not saying that's what's going to happen, but it'd be nice to know if this advisor looks you in the eye and says, I care about you, I care about your risk. How are they measuring it? This is one way to do it. And again, you're going to be shocked in almost every situation. We also have a range of returns. This simply will show you that based on historical data, what is the range of my returns that I should expect? Should I expect over the next 12 months a return range of -5 to +15? Could you handle being down 30% in the next 12 months? Look at that. I think you'll be very shocked. And then also in some of the calculators, we show you what the asset value could potentially be over the next 10 years. But these are the most important analytics. Any questions about this? Feel free to give me a call. But when you're analyzing a portfolio, you're analyzing an advisor, you're analyzing a firm, you really want to know a lot more than just being sold something or just believing somebody because they work at a good firm or they have a good image. You deserve too much. You deserve a lot better than that. So these are the 9 key portfolio analytic measures or metrics that you should measure your portfolio based on. Thanks.